host, it is my pleasure to introduce Todd Williams, the VP of Consulting Relations, and also Kevin Lewis, the Senior Client Portfolio Manager with American Century.
Great. Thank you so much, Leah. We appreciate you guys giving us the opportunity to join you today. We've done these calls in the past and always find them very interesting and engaging, and we hope you will find the same here. U.S. Premier Large Cap Growth is the composite name for our Ultra mutual fund. Many of you are probably familiar out there in the 40 Act mutual fund, more with the Ultra nomenclature, but that is the underlying strategy here for our large cap growth for CIT. So Kevin, I'll turn the floor to you and I'll move the slides.
Great. Thanks, Todd. And hello to everyone in the RPAG network. So we're really excited to talk about Premier Large Cap Growth as a vehicle for you to consider for your clients. So as Todd is showing on this page, page 2, there's a couple of points I want to make. First, at the top of the page, American Century was founded in 1958, Kansas City, Missouri, but our history and legacy as a firm is really based in U.S. growth investing. And today in U.S. growth equity assets, we have $46 billion. Within that green box, you see the 4 strategies that my team manages using one team, philosophy, process, and its portfolio construction that differentiates them. So we're here today to talk about the Premier Large Cap Growth strategy. You can see it has $17 billion in assets. The demand this year has been quite strong, as others in the market may not be finding their way so much. So we've been the beneficiary of almost $1 billion of inflows, and for that we're very, very appreciative. And the reason people choose our strategy is really shown on the next page. If we could flip the page to 3, right? So we have a record of managing the portfolio for over a decade. And that record, as you see at the top of the page, shows that our performance is 100% of the time over the last decade been above average. And in fact, been ranked top quartile over that rolling period of time. At the bottom of the page, frequent checklist numbers that consultants and fiduciaries are looking for. What's the most recent 5-year excess return? What's the most recent 5-year risk-adjusted return or information ratio? And I think to me, within the retirement plan world, one of the underlooked or very important numbers is the batting average. That is the number of months that we've outperformed the benchmark compared to our peers. I call this mailbox risk. So, there's a great deal of persistency and consistency to our performance pattern. The reason behind that performance that you see on that page is shown on page 4. And these are really the key takeaways in my brief conversation with you today. If I have you leave this meeting with anything, I'd ask you to try to remember what's in these 3 gray boxes when you think about our strategy. First, we're going to talk about how we have a dedicated team with unique industry practitioner experiences that we bring to the research process. Second, how we invest in quality, sustainable growth companies using a long-term mindset. And third, and importantly, how we construct the portfolio to emphasize our greatest competency, which is stock selection, and not try to create differential based on sector tilting or characteristic tilting. The 3 of those in synergy are what have led to the proven long-term performance record. And it starts with the team, which is on page 5. So you see the 3 named portfolio managers. As I mentioned before, Keith and Michael have been portfolio managers on the strategy for well over a decade. Jeff Burke, who was an analyst before he was elevated to the portfolio management position in 2013, has also been a long-term member of the team. But I think what really differentiates our team is how we operate, which is shown on the next page, page 6. So the first differentiation is that we are a dedicated team. So the 9 people on this page are fully dedicated to ensuring that the needs of Premier growth are met. Many firms will use an outsourced research model. That may be fine for them, but it's not work for us. So as we have issues in the portfolio, priorities in the portfolio, we have the resources on the team who are fully aligned with ensuring its success right there to, in an expeditious manner, address those issues. The second differentiator about our team is that we make all decisions collectively. So it's not the 3 portfolio managers. Indeed, it's the 9 people at the top of the page who vote about what comes in and what leaves the Premier Growth portfolio. We think that the wisdom of the 9 people on this page lead to a better conclusion than a single analyst pitching a single idea to a single portfolio manager who may not think of every issue. And so we look at a stock that's pitched from multiple issues, from multiple sectors and multiple experiences. And that brings up the third differentiation, is that many people on the team have industry practitioner backgrounds in the fields that they research. So I'll call your attention to Michael Lee. He's a former drug research scientist for Bristol Myers Squibb. In that capacity, he's brought drugs to market. He's authored scientific white papers that other scientists have used. So if you want to know who is the lead healthcare analyst on the team, in addition to his portfolio management responsibilities, Michael is using that background as he meets with healthcare companies, pharmaceutical companies, and is meeting layers deep into that company beyond the CEO, the CFO, to the chief scientific officer, so that he can be talking drug scientist to drug scientist about what are the drugs in the pipeline that are going to drive the future growth that we care so much about. 2 other people I'd highlight on the team that have also unique experiences in addition to the others with industry practitioner experiences. You'll see Chris Krantz. He's also a former CPA. And in that regard, we're able to always put companies' accounting statements side by side. And if there's adjustments, we can make sure that we're looking at them apples to apples. So having a former CPA on the team in the world of ever-changing accounting methodologies is very important to us. Lastly, someone you don't see in this industry very often attached to a team is Tong Lee, who's on the bottom right-hand corner. Tong is our dedicated risk management and quantitative analyst. Every decision we make is based upon what is the sustainable growth of this company into the future, what's the valuation of that company's growth, and thirdly, what's the risk as we add this stock to the portfolio? What does it do to the risk profile? So Tong is a voting member of the team. He's part of every conversation. And so when you look at our returns in terms of their persistency and the risk-adjusted nature, it's probably not too surprising that they rank quite highly because of the insights that Tong brings in helping us manage the portfolio. So the language we speak as part of a dedicated team is a single language, which is our investment philosophy, which is shown on the next page, page 7. That is, we are a quality-oriented investment team. And so we're looking at first, quality businesses or good businesses. And the definition of that business is further defined by it having a competitive advantage. That could be because it's a better management team, a better business model, a better product or service. And the signature of that competitive advantage is above average profitability versus peers. It's with that profitability that as we meet with companies day in and day out, we're asking them, you've got above average profitability and a competitive advantage. What are the opportunities to reinvest in this business? If they tell us there are no reinvestment opportunities, then it's not really a useful growth stock for us. Maybe a decent value stock, but for us, we want a company that has opportunities to grow and scale the business where the scale gives it unit economics that make it very, very attractive and further enhance the competitive advantage. And we invest in these good businesses when they're showing metrics of accelerating growth, relative strength, and valuation. One example of a good business that we've owned for a long time are MasterCard. Many people think MasterCard is the issuer of the cards. That's actually the banks. MasterCard and Visa own the infrastructure that those credit card transactions run over, and they take a cut of that transaction as it goes across their toll road. That duopoly structure of the of the payments network that they and Visa operate leads to profitability of about 50%, 50. So a dollar comes in the front door, about 50 cents goes to the bottom line. Their growth, as we've been talking to them, is not only enhancing the services that they offer, but in particular, growing the business overseas, because many transactions overseas are still done by cash or check, where the majority are done in the US by digitally. So they have plenty of opportunities to continue to grow the business, which gives it additional scale, and it further supports that flywheel effect that we're looking for. And that's why we've been long-term investors in MasterCard. And so it's a company that's just compounding capital at a high rate that we see is really insulated because of its competitive advantage. We identify these opportunities and we translate this philosophy into everyday practice on the next page, the portfolio process page. I know you've seen a number of pages like this, so I'll just really be brief and talk about the differentiators of our process as they compare to others that you might see. First of all is the investment universe. We are monitoring an investment pool of companies that starts with 2 billion and above. Now, we are a large cap growth investment manager, but we will utilize the upper end of mid caps if there's sufficient trading liquidity to find those companies well positioned to grow years into the future. On that investment universe, we have a proprietary ranking model that we designed and we programmed to be watching for the stocks that should be getting further investment analyst attention. So that ranking model will narrow down that 1,000 to 1,200 companies to about 200, 250 stocks. So that ranking model is unique and proprietary to us. And then our fundamental analysis is a little bit differentiated. We're going to strive to meet with that company at its headquarters. We meet with over 250 companies a year, 150 at their headquarters. Not everyone can tell you that they get access to those companies, but because of our shareholder philosophy of being long-term investment holders in companies, to having a long-term mindset and having the scale of the assets under management at American Century, we can get access to meet with the senior management teams that we really want to get in front of. That fundamental analysis when meeting with those companies is really driving at what is the quality of the management team that's running the business? And you see all degrees of management teams out there, but we want to make sure that they would be good stewards of our capital, because in essence, we are turning over the capital for them to further grow the business. Can they make the right decisions? What are the decisions they'll make in today an inflationary environment, but are they continuing to be thinking long-term to grow the business, not just focused on the next quarter? Further, we're going to try to meet layers deep in the organization. As I mentioned before, healthcare companies, frequently that's the chief scientific officer, where Michael Lee and his drug research background can talk drug scientist to drug scientist. Keith Lee, who is a former software developer covering technology stocks, is going to meet with the chief technology officer, and it goes on and on. What we are doing is we are trying to identify the catalyst and the positioning to sustain the above average growth, because we believe in the wealth generation and value creation from long-term compounding of fundamentals at a high rate. So we are looking for the underpinning within the organization, the opportunities to continue growing. We're going to take that information and build a long-term proprietary financial model looking well into the future. That model is going to also serve as a way to value the company using a discounted cash flow analysis. The model, the thesis, the valuation are all presented to the team that I introduced you to. I'm taking questions to the analysts and asking them as they're pitching the stock. One of my favorites that I ask is frequently, how is the model different from Wall Street, and how certain are you of that difference? Because to me, that's going to help drive a catalyst for appreciation. We then construct the portfolio. We then vote as to what goes into the portfolio, and the majority vote getters are the stocks that are added. And part of that tally sheet is also who are the companies that we should be taking capital away from, if not further fully moving out of, to create room for the new stock that we're discussing. The portfolio is managed with between 60 and 90 holdings, so it's a diversified portfolio. And how we construct the portfolio is very, very important. So Todd, I'm going to call an audible here and have you turn over to page 12, if you will. That's our portfolio construction guideline. On this page, there's a lot of metrics, but I'll cover just a few of those that are really the important ones. You see our expected tracking error. We're going to be statistically different from the benchmark, 200 to 600 basis points. And importantly, the next line is the driver of that differentiation. Todd, if we could flip back one, please. The driver of that differentiation, the next line shows risk from stock selection over 50%. We want the portfolio to be actively positioned versus the benchmark due to stock weighting decisions, owning MasterCard, underweighting or avoiding another bank in the financial sector to create that differential and not reliant on the sector tilting, which you see sector exposures are limited to plus or minus 5% and not driven by a large allocation to non-US or market timing. In this business, we see a number of different approaches to manage portfolios. You're going to see competitors that are going to show timing of cash, large sector tilting, and then stock selection, all to drive the alpha. I'm not saying they're wrong. I'm just telling you we don't have a model to time sectors or to time cash, but the capability that we have the most control over to deliver alpha is to do deep fundamental research and to identify those companies positioned for long-term growth that can compound fundamentals at a high level and hence lead to value creation or wealth creation. And so we construct a portfolio solely around that. On the next page, if you could turn, please. Yes. This pie chart shows where we're currently positioned in the portfolio. You can see in the green on the left, 2/3, our objective is over half, but 2/3 of the difference from the portfolio vis-a-vis the benchmark today is driven by stock weighting decisions. Risk indices, call that characteristic tilting, beta, size. We don't take bets on those. We do tilt on growth, and we do tilt on price momentum and to a limited degree, price to earnings ratio, but we keep those very constrained. And you see industries, call it sectors, very moderate degree of differentiation. Remember, it's only plus or minus 5%, stems from sector tilting. And we want to make sure that we have a diversified portfolio and we risk manage the ideas in the portfolio. And that's shown on the next page. What we're doing is we're going to be fundamentally overweighting these stocks in the portfolio, but making sure that no stock dominates that risk positioning. So let me walk you through this page because it is differentiated because we have the benefit of a risk management analyst on our team. The far right column, active weight, simply shows the weight of the position versus that of the benchmark, but that doesn't tell you all the risk that that position creates in the portfolio. Active risk is a metric that's designed by a risk management software called BARA that's widely used in this industry to look at how much risk does Tesla create in the portfolio by being overweight. What are its characteristics? What's the other sector tilting? So we don't allow any one company to be more than 10% of the risk budget. So you see 6.6% for Tesla. Indeed, 2 to 3 years ago, we were trimming Tesla back as it was appreciating in value because it was breaching that 10%. What this means for our clients is that we don't want the portfolio to be driven by a handful of companies. We want a diversified alpha set of businesses to be driving the outcomes of the portfolio. The other thing we do is we focus strongly on quality, as I mentioned before, in good businesses, and that's shown on the next page. These good businesses of the portfolio across time over the last decade are shown in green of our portfolio versus blue of the benchmark. For us, quality is defined by profitability, and you see that the portfolio has consistently had higher profitability than that of the benchmark over the last decade. On the next page, we show our philosophy about trading. and portfolio trading can be very expensive to managers. We don't trade the portfolio. You'll see at the top that we have about 20% or less turnover of the portfolio. And at the bottom, that ranks us in the bottom of the class, which we're proud to be. Portfolio trading has an explicit cost for commissions and an implicit cost on market impact. And we are frequently, because of our deep fundamental research, thinking long-term, we'll use short-term volatility as a disconnect from the long-term value of that company. So we're frequently, our reaction is to be adding to those stocks, not retreating or backing away from them on pullbacks. So now let's talk about what's the market environment for growth and how is that the portfolio performed. So on the next page, what we show is the payoff to growth within the market. And this is provided to us by Barra. As I mentioned, they help us manage our risk of the portfolio. The green line shows the rolling payoff over the last long period of 30 to 40 years. Over the last 12 months, ending 8/31, growth as a characteristic in stocks has created a 400 basis point drag. Other elements like size, volatility also add to that drag. But here we're talking just about the payoff to growth, to which we have an above average exposure in the versus the benchmark. That 400 basis point drag over the last 12 months represents over a 1.7 standard deviation event to the downside. So if you have clients who are nervous about growth investing, I would say that the investment market is all about probabilities, and growth is now performed at a negative 1.7 standard deviation event. It's like a coiled spring. I can't tell you that the spring is going to unlock tomorrow, but I can tell you that is statistically attractive in terms of an entry point to be looking at higher growth managers such as U.S. Premier Large Cap Growth. On the next page, we'll show our performance. This is of the CIT, but I'd rather, Todd, let's turn to the Composite Performance, which is on page 19. Perfect. So what you'll see is that we'll start from the right, move to the left. Over the last decade, we've been managing Premier Large Cap Growth. We've grown our clients' money at about a 14.8% annualized return, which is above that of the benchmark, 13.6. You do see our net of fee performance in there. I might add that our composite is dominated by our mutual fund. So that is not the pricing that you would get on the CIT, of course, but that is what that net of fee represents to the large part. So the 10, the 5, the 3-year periods, we've all been well in excess of the benchmark. As we showed on the previous page, the last year has been a risk-off, risk-averse environment. Growth has been penalized, as you can see in the 1 year and the year-to-date figures. But for the quarter, as growth came back and was rewarded, as you would expect, Premier Large Cap Growth was rewarded. So we are not solely dependent upon growth working, because our attribution is driven by stock selection. But let's move from that snapshot of performance to how has the performance been delivered over the last decade so. So let's turn to the next page, Todd, if we could. The pie charts speak volumes about our performance contour. Over the last decade, looking at every 3-year window of return, we've outperformed the benchmark 92% of the time on a gross fee basis, with an average excess return of 178 basis points. Over the last decade, we've been managing the portfolio on a rolling 5-year window. We've outperformed 100% of those time frames with an average excess return of 184 basis points. And it's important to know that that attribution or that alpha is driven by stock selection, as we can turn to the next page, Todd. Many consultants love to see this page because they frequently say, Kevin, how is this alpha delivered? And everything I've told you today is it's about stock selection, our team, our research process, our portfolio construction. The gold bar on the right shows that we've outperformed the benchmark since we've been managing the portfolio for about 660 basis points. And then if you look on the left, the driver of that excess return is the green bar stock selection. The two bars in the middle, industries call that sector tilting, risk indices call that characteristic tilting. Net have been moderate detractors, but stock selection, if you go to the bottom of the page, has been positive as a contributor over every rolling 5-year window of time that we've been managing U.S. Premier Large Cap Growth over the last decade. One last page, which is on performance ranking versus peers. You'll see this ranks quite strongly in terms of fiduciary checklists about what are the characteristics that they want in their investment manager, particularly large cap growth, our annualized return over the last 10 years, our risk-adjusted return, something that we are compensated on, our batting average, which is very strong and consistent. All, I hope, meet the characteristics that you would be looking for in a large cap growth manager. So I'll close with this and see if we have time for any final questions. We think, an ideal candidate for you to be using in your retirement plans. The reason that we think that is our performance record is backed by a team that's dedicated to this strategy, that's filled with industry practitioners who are doing the day in and day out research and doing that deep, rigorous fundamental research to construct the portfolio around what we do best, which is investing in high quality businesses that are capable of sustained above average growth over time and will create wealth as they compound their fundamentals at a high level. Our portfolio results show that we've been driven by stock selection and have created a very consistent performance contour. So Todd, I'll turn it back to you.
One thing that I did want to highlight, and very good job there, Kevin, very comprehensive in covering that in a relatively short amount of time here. The RPAG, the large cap growth 4 portfolio, is priced all in at 34 basis points. So very attractive pricing, especially if you look at the mutual fund equivalent here at American Century or other vehicles. You guys are getting a tremendous value there in that portfolio at 34 basis points. So
when does the fund go live?
Yeah, I'll answer that question. It is currently live. So at the end of August, it was set up through Wilmington Trust. So you're able to go out there and request the large cap growth for CIT RPAG version there. There is a class 1 and class 2. The class 1 is no service reimbursement. There is a 25 basis points in the class 2. And it is set up right now, I know, on a handful of record keepers, including Empower, Voya, T. Rowe Price, Batrix, and there was a few more, Fidelity and Ascensus, I know, are in the queue. If you have any questions regarding the setup at a particular record keeper, please, you can reach out directly to me. My information is, Leah has it here on the Zoom call, but also your local American Century DCIO salesperson, and we'll be happy to get you the QSIPs sent over so that you can request that directly at the record keeper.
Well, thank you so much, Kevin and Todd, for your time today. We appreciate you giving, you presenting and updating us on this new CIT, which is super exciting. And without further ado, we'll go ahead and close for the day. But thank you so much, everyone.
Thank you.
Have a great day.
Thanks, everybody.